Hey, welcome back. It's Jason Walter here. As home prices climb to near record-breaking levels, the Federal Housing Finance Agency, or the FHFA, announced Tuesday that loan limits for mortgages that can be purchased by Fannie Mae and Freddie Mac in 2022 will rise by the highest percentage ever. I'll discuss which potential impacts this could have on our housing market here in just a little bit. But to give you a brief background, the conforming loan limit is adjusted each year to reflect the change in home prices across the country, and that means, of course, a significant increase next year. For much of the United States, the conforming loan limit will rise to $647,200 in 2022. That's an 18% increase from this year's limit of $548,000. That equates to almost a $100,000 rise from 2021. In more expensive housing markets such as Los Angeles County, the San Francisco Bay Area, Washington, D.C., New York City, and parts of New Jersey, including the entire states of Alaska and Hawaii, this new loan limit in 2022 shoots up to almost $1 million, $970,800 to be exact. And that's up from $822,000 in 2021. The FHFA, which regulates Fannie Mae and Freddie Mac, stated that the increase was based on the surge in the home price index from Q3 2020 to Q3 2021. During that time period, home prices soared by 18.5%, which is an all-time record high. FHFA's economists said home price appreciation reached its highest historic level in the quarterly series ever. Compared to 1 year ago, annual gains have increased in every state and every metro area. So in other words, we're not talking about a housing market in the US where just one region surged, we're talking about the entire nation. So for example, home prices rose in all 50 states and the District of Columbia between the third quarters of 2020 and 2021. And check this out because this is absolutely nuts. The 5 states with the highest annual appreciation during that time period, Idaho is number 1 at 35.8%, Utah 30%, Arizona 27.7% increase, and Montana a 26% increase, followed by Florida with almost a 25% annual increase in home prices there. In contrast, the 5 areas with the lowest annual appreciation were the following: the District of Columbia, North Dakota, Louisiana, Maryland, and Iowa. Even though those states were at the bottom of the list, it's important to point out that all but Washington, D.C. experienced a double-digit increase from 1 year ago. In addition, according to the National Association of Realtors, the median sold price in the U.S. increased in 99% of housing markets across the country during the third quarter, and 78% experienced double-digit growth from the previous year. And because home prices skyrocketed during this time period, the conforming loan limit was increased. So you may be asking yourself, how does this increase in the conforming loan limit, how could that impact you and also our housing market in general? So let's discuss. So to give you a brief background, conforming loans are loans that meet guidelines to be purchased by Fannie Mae and Freddie Mac. Those are government-sponsored entities commonly referred to as the enterprises. Conforming loan limits are uniform for most states, but they are higher in high-cost areas such as the Bay Area, Los Angeles, New York, etc., like I discussed. When these loan limits are increased, this of course widens the buyer pool of those who can qualify for these types of loans. It's important to point out that home loans that are above these limits of conforming loans cannot be backed by Fannie Mae or Freddie Mac. Therefore, if a home buyer wants to purchase a house using a loan above these conforming loan amounts, they have to use what's called a jumbo loan. And of course, the major downside of jumbo loans is that they are harder to qualify for. So for example, you may face stricter underwriting criteria such as a higher credit score and higher down payment requirements. In addition, not to be confused with FHFA, the Federal Housing Administration, or HUD, will announce next week what their loan limits will be for their FHA loans. HUD normally announces the revised loan limits for their FHA loans about a week after FHFA announces theirs. This is because the Federal Housing Administration bases their maximum loan amount based on the maximum conforming loan amount. And one thing we should anticipate for FHA loans next week is that they are set to increase their loan limits as well. So big picture here, the impact of rising loan limits means that more people can take advantage of these high balance loans without having to qualify for a jumbo loan. And of course, this could cause home buyer demand to increase, and thus home prices could also increase as well. Looking ahead into 2022, the key factor impacting our housing market, in my opinion, will be mortgage interest rates. If you follow my YouTube channel, you already know that the winding down of the mortgage forbearance program is not going to be causing a housing market crash. As of the end of last week, there were only 1 million homeowners in forbearance, and that's down from almost 5 million in May of 2020. The vast majority of the people who have ended their loan forbearances so far have opted to do a loan deferral, which basically means they add in all their missed mortgage payments to the back end of their loan, and their mortgage payment remains the same. In addition, the expiration of the foreclosure moratorium as well as the eviction moratorium is not going to crash the housing market either. So for example, we're not seeing an excessive amount of foreclosures compared to pre-COVID, and largely this is due to the rise of home prices and of course the rise of people's equity in their houses. So instead of focusing on forbearances and the expiration of the foreclosure moratorium as well as the eviction moratorium, in my opinion, it's much better to track what's going on with mortgage interest rates because that could have a greater impact on our real estate market. As you probably already know, mortgage interest rates are tied loosely to the 10-year US Treasury yield. So let me give you an update regarding that and what we should expect going into 2022 for mortgage interest rates. At the time of filming this video, the yield on the 10-year US Treasury note is around 1.45%. However, the yield has been decreasing ever since November 24th. A decrease in the Treasury yield can also cause mortgage interest rates to fall as well. So have a look at this. This is from the Mortgage News Daily. And as you can see, the average 30-year fixed rate mortgage has been trending downward also since November 24th. We went from 3.29% on November 24th to 3.18% on December 1st. So what's happening right now is that Treasury yields are holding steady due to fears around this spread of this new variant, in which 2 cases so far have been reported in the US at the time of this video, and that's in California and also in Minnesota. Investors are also watching for the possibility that the Federal Reserve may wind down its purchases of mortgage-backed securities earlier than planned. Fed Chairman Jerome Powell stated the following on Tuesday. At this point, the economy is very strong and inflationary pressures are higher, and it is therefore appropriate, in my view, to consider wrapping up the taper of our asset purchases perhaps a few months sooner. He said, I expect that we will discuss that in our upcoming meeting, which will be in December. The current tapering schedule by the Fed would have seen bond purchases end by June of next year. However, if the Fed chooses to accelerate their tapering, that could mean a springtime end date, which of course could pave the way for an interest rate hike sooner than anticipated. However, it's very important to note that the Fed does not control mortgage interest rates. Instead, they change the federal funds rate, which is the rate that banks charge each other overnight for short-term loans. Although fluctuations in the federal funds rate can change mortgage interest rates, there's not a direct correlation. Instead, a better indicator is a 10-year US Treasury yield. So because mortgage interest rates are tied more directly to the US Treasury yield, you may be asking yourself, what impacts the yield on the US Treasury note? The answer is investor sentiment. So when investors feel positive about the economy, they are less interested in treasuries and move to buy more risky investments such as stocks. Therefore, the prices of treasuries dip and the yields rise. In contrast, when investors are more concerned about the health of the economy and its outlook, they are more interested in buying treasuries, thus pushing up prices and causing the yields of those treasuries to decline. So how can we expect mortgage interest rates to change as we go into 2022? Well, here are some examples. So Fannie Mae expects that interest rates will average 3.3% throughout the entire year of next year. The Mortgage Bankers Association foresees rates averaging 3.3% in the first quarter and 4% for the full year of 2022. And according to CoreLogic, the 30-year fixed rate mortgage should hover around 3.4% by the end of 2022. The reality is no one is an accurate real estate fortune teller, and they are just basing their estimates based on current data in hand, and a lot can change. And of course, those changes could impact the yield on the 10-year US Treasury note as well as mortgage interest rates. And speaking of mortgage interest rates, I made a separate video about the pros and cons about refinancing your mortgage. If you're interested in watching that video, then check it out right here. Also, if you got any value out of this video, then please hit the like button. I greatly appreciate that. Hope you have an awesome day and look forward to seeing you on the next video.